Good morning at NTV. My name is Malaki Vilodera and this segment is the Take Note segment, and today we'll be teaching you how you too can invest in the stock market. What does it take? What's the process? So in studios to shed some more light on that is Mr. William Nyakatura, who is the founder, Kinsman Advisory. Thank you so much for making time.
Thank you for having me.
There's this notion that the people who can invest in the stock market are the elite, the rich, but you actually told me that I too, the viewer watching us too, can invest in the stock market. What's the process?
And that is the essence of the stock market, inclusion. I think the challenge is the awareness, the ability to know that you can actually walk to the licensed stockbrokers and actually get serviced. In the sense they would help you buy the companies that are listed on the stock exchange, which is the Uganda Securities Exchange that has 8 local listed companies. And this week, as we all know, CIPLA is actually closing, I think, today. People have the opportunity to buy into this IPO through their licensed stockbrokers. Anyone and everyone who feels that they have some money to actually bring to the table.
What's some money?
Yeah.
What's some money?
What's some money? I generally think that the minimum one should actually start with is 100,000 shillings.
Really?
You want to make the investment meaningful because naturally the return is going to depend on how much money you actually put down. So if you can actually raise 100,000 shillings and go as far as you can, we like to believe it's nice to have a bad habit of saving. And if every once a month you can actually put 100,000 in a growing company, you will be rewarded in time.
So roughly 100,000 Uganda shillings will get me how many shares?
Now that varies from company to company, as
right.
each stock has its own price. Let's say for argument's sake, Stanbic is trading at 30 shillings, you'll probably get what, 30 shillings, you'll probably get what, 30 shares, something like that. And if you actually also look to Uganda Clays, I think Uganda Clays is trading at 28, Umeme is trading at 320 or around 340 shillings.
Right.
So each stock particularly has its own stock price that would of course vary in relation to the money that you put down.
I know the secret in making profits while investing in the stock market is in the numbers. Volumes matter. So what's the secret? If I just can afford extra change per month of maybe 100,000 only, nothing more, is it advisable to then invest constantly per month?
Yes, that is just part of the secret. I think what an investor should try and do is also understand what exactly he's buying. Is the company actually growing? Are they making any headway in capturing market share? Are they profitable year on year? If that is the case, and you have this habit of buying shares monthly over a period of time, then you'll be rewarded by the returns that the company pays in form of dividend, a portion of their profit. But then everyone else will also start seeing that company, and then they will want to buy those shares from you at a higher price. If you, on the other hand, pick a poor company and you cannot tell that its performance is either stagnant or declining, no matter how much you keep acquiring of it, it won't make a sound return for you.
You'll just make losses.
In truth, it will. It will reduce your wealth. Yes.
Okay. All right. So you've mentioned that just doing your due diligence is very important, but over and above asking for guidance from the stockbrokers, how else can the viewer go about just finding out if company X really is, a good company to invest in, if they have, a stable structure when it comes to, the financial implications, and if they actually make profits as a company?
I'm glad you asked that question. I think once you have dived into the pool of buying shares, there is now the habit of now consuming research. So the brokerage firm that you select must have the ability to give you a research note on the company. And the broker also has the responsibility to educate you on the ratios or the mathematics that is used in gauging the performance of a company. The better you get at that particular trade, the quicker you are at seeing an opportunity and also seeing a pothole, and then avoiding that particular pothole. Because if you can clearly see that, let's say, the cash flows are not increasing, when cash flows drive earnings and earnings drive the share price on the stock market,
right,
you start to get a sense of what is to come. And when you go to the AGM and you can hear management talk a very big game, but the numbers are saying something totally different, you start to trust your gut. If you don't do the numbers, then you're very dependent on management and very dependent on your stockbroker, which I don't think is a good thing for the investment public. Over a period of time, we must get you to understand these things slowly and better. It's like playing chess. If you don't understand the rules of the game, an amateur can play on the other side and still beat you.
Right. Right, right. But you also mentioned that you actually have to go through a stockbroker for you to purchase this, you know, to actually play in the stock market. But is it important to go through a stockbroker if I'm just a beginner and I just have my 100K to start off?
It is the only path through which you would access the stock market. It's the only path. So, and since they are regulated, and since you want security and safety in the qualifications that they have and also the professionalism that is required, they are regulated by the capital market and members of the Uganda Securities Exchange. So you want to go through a safe channel. And if you go through any other entity, they won't be able to present you on the stock exchange, because remember, they have to be members of the Securities Exchange to represent your trade or your interest. So it's as simple as that. You'd have to find among the 7 or 8 licensed brokerage firms in the country and try and place your trade through them.
Okay. And what percentage of my money are they taking?
Yes, the pound of flesh that we always ask for is really, it is set by the capital markets. It's actually 2.1%. It's fixed.
Per purchase?
Per purchase.
Okay.
So depending on how much you come with, the fee then just keeps adjusting. However, for large institutional investors, we have what we call a reducing scale balance. So in other words, that 2.1% starts to reduce in relation to a certain amount. I think it's above 200 million. If you start investing above 200 million, the scale starts to reduce. Okay. Naturally.
All right. Yeah. So the volumes actually play a positive, you know, part in just bringing down the flesh that you take as a broker.
And the price is set, like I said, by the stock exchange, so by the stock brokers association and the capital market. So we then just compete on the quality of service we give our clients.
Okay. Let me ask you a question. So I've gotten into the game. I'm now playing in the stock market space. I have shares, and I want to really make profit out of selling my shares to other people. At what point would you advise someone to sell off their shares? What factors should they look out for before they actually sell their shares?
So this is where, again, it comes in to have a wealth manager before you find a stockbroker. You see, a stockbroker executes your interest. But if you find a wealth manager or a consultant, he helps you set a particular goal. And if at any one point the stock does not meet that goal, then it is advisable that you trade it for another asset that will get that goal. So if you don't have a wealth manager, then I tend to think that the best time to sell a stock is if you feel there is another investment out there in the market that will get you a better return than the current one. Whether it be a passive investment or a direct investment, don't become emotional about it. Exit this particular position and chase the return that is possible with the one that you can clearly see. If on the other hand you cannot see that opportunity, please stick with what you have.
Let me ask you, is it a must for someone to get a wealth manager? Isn't it the role of the stockbroker to give me off all this information?
No, we're not a one-stop shop.
Okay.
I think what you have as a stockbroker is a person who executes your trade. So in essence, when you come to a stockbroker, he's under the impression you know exactly what you want. Hence, the questions that you ask him, he will provide you answers in relation to that.
Right.
When we think of a wealth manager, he's a person who sits down with you and really combs what plan you probably need to arrive at a certain goal. It's a very uncomfortable process, but it's usually given to the high net worth individuals who seek
uncomfortable process meaning?
Uncomfortable process in the sense that you've got to be very realistic with yourself and tell the truth at all times, like a lawyer.
Be an open book.
Be an open book, because it affects your pocket. So if we believe tomorrow that a certain event is going to play out, like let's say you're about to retire in the near future, then we must plan for that. Then that means you probably should not invest 100,000, you should probably invest 700,000 consistently in a particular asset, that is going to hit your home expenses.
Right.
So, but it is a planned strategy. So it becomes meaningful that when you buy a stock, it had better serve the purpose that it was bought for. If it doesn't serve that purpose, then you trade it for one that should.
Let me ask you, if I've bought shares and they're actually doing well, adding value, and the costs are going up now, making profits, is it advisable to just sell off everything or keep some to yourself?
Again, it falls back into your plan.
Mm-hmm.
If you believe that you do not need the capital or the total amount at this period of time, or there is a certain need, whether it be for consumption or for expansion elsewhere, then you can reduce the portfolio as you see fit.
Mm-hmm.
On the other hand, if you foresee that the stock has reached its zenith, its top, and you think anything but now should come down, otherwise it's overpriced, then that is good timing and good sense on your part to actually exit the market, wait for the tipping point to fall off,
mm-hmm.
and then buy the stock again.
What are the implications of exiting a market?
Well, you get cash paid into your bank account, and you can do other things with that capital. You can either buy a government bond and hold that money for maybe, you can buy a treasury bill and hold it for 3 months, 6 months, or 1 year while you're waiting for other opportunities to show themselves.
So what you're saying essentially is when you get into the stock market space, you're not guaranteed of profits. It's a gamble. It's a risky space.
I tend to think everything in life is a risk. It's just that you must gauge that risk right. In other words, you've got to do the homework that is required in seeing if there is an opportunity. If you buy a company and you can see that the market share is not growing, or there is a replacement for their product in the industry and many people are buying that replacement, and you still buy that company, then that is a risk that you should prepare yourself for.
Right.
So in order to reduce that risk, I would suggest, and see more opportunity, is try and read more about the company, its sector, who is serving it, and who is buying.
Mm-hmm.
And if you can see that people are in need of that product, can I give you an example?
Yes.
I keep giving this example in my classes, that Visa. Visa is a company that people don't see, but gets to be used. And if you think of the volumes of trades that happen on Visa cards around the world, are just humongous.
Right.
But that money has to go somewhere, which is the revenue books of the company. And if you then look at the financials of the company, you can actually see that this company is going from strength to strength as more people decide to use more online transactions or ATM transactions. That is a good sign that if I bought this particular company, it's likely to have a positive return for me.
Okay. All right. But of course, as we come to a close, there's this one question everyone is yearning for. Between investing in the stock market and starting out a business, which of the two would you advise?
I think the two can go hand in hand, and none is competing with the other.
If you have to choose one?
Unfortunately, that shouldn't be the case. If you are maybe a doctor or a specialist, you're making a return from your skill, that's fine. Then you need a passive investment, an asset that makes money without you being there. If on the other hand you're a businessman, it can't hurt you doing active returns, but then also complementing it with passive investments. So it's not a catch-22, it's a wise thing to do both if you can. Be employed, but own assets that also make money.
Okay.
Be a businessman, own assets that also make money.
Okay, all right. And at least now we know that to get into the market, you just need 100K.
Well, we hope it's not a challenge for many.
Yes, 100K, of course, when you save up, it's possible to actually invest that in the stock market. But before I let you go, there's this question of, okay, I have my 100K or my X amount of money that I really want to, invest in the stock market. But how long will it take for me to see gains in my investment?
Okay. I'll answer this again using an organic kind of picture. When you put a bean in the soil, it takes quite some time for that bean to actually first grow. And then when it shows its cotyledons, it's not the time to reap. And then after some time, maybe 3 months later, then you have, the bean pods showing up. You have got to allow the investment to grow. to go through a sense of maturity. If you try and rush the process, you most likely haven't let the opportunity come to its full term. And if you have a short-term kind of mentality, then it becomes challenging in this Ugandan market to make an actual return. It has got to be a long-term kind of investment and one that falls within your financial plan.
So ideally, how long will it take for me to start seeing, maybe gains or just some action in my investment?
Again, it depends on the stock that you pick and how productive that particular company is in the sector, in the country. The return you will most likely make from Stanbic won't be the same you're likely to get from Uganda Clays because of the revenue raised. Stanbic has more potential to raise a lot more revenue than Uganda Clays. So it's a hard question to answer if you're looking for a one-liner. So it really comes down to time.
You can't put a timeline to it?
Nope, I wouldn't be able to.
Okay, so what you're saying ideally is investment in the stock market should be a long-term goal, a long-term plan for anyone getting into that space. It's not advisable to get into the space if you want quick and short-term.
There are other instruments that do that, and unfortunately, I do not think the stock exchange is that place for those short-term investments. If you probably are looking for short-term, then buy a government T-bill, which has 3 months, 6 months, and 1 year. If that doesn't suit you, then you probably go and buy a fixed deposit with your bank. Those instruments allow for those kind of timely withdrawals.
Tell us a little bit more about the government T-bill.
So the government T-bill is a debt instrument within which the government says, lend me this money and I will pay you a certain set interest rate, which is then guaranteed that the government will always make sure that you will always find that money. They can either raise revenue to pay you as an obligation onto their shareholder and to the bondholder. So if you want to actually buy a government bond, you can actually go to your bank. Your bank being, I think they're the 4 prime banks, which is Stanbic Bank, Standard Chartered, DFCU Bank, and I'm not so sure, but I think Centenary Bank is among them. And when you ask them you want to buy a government bond, they will help you meet that desk that will guide you in actually buying the T-bill, which is either 3 months, a 6 months, or 1 year investment. It then goes up to a 2-year, to a 5-year, and to a 10-year.
And you're assured of your return?
You're guaranteed your return.
With profit?
Yes, you are guaranteed a return.
And how much ideally should I have for me to invest, actually, get into that space?
It's 100,000 again.
Ah, okay.
Yes. I believe it is 100,000 or 100 or 200,000, but I believe it's 100,000.
Yeah. Okay. All right. That's a great space to get into. Many people didn't know about it. And so, like you're saying, it's a short-term plan. The government T-bills just give us 6 months, and of course it stretches to 5 years.
Yes.
Depending on what you really want.
Yes.
Okay. All right. Thank you so much for coming in studios.
Thank you.
Before we come to a close, what is the tip that you can leave us with?
I think, like the last conversation we've just had, I'd encourage people to actually look at government bonds. They would be surprised what returns they could make in a 1-year bond vis-a-vis maybe property. Rarely does a property rental return, ROI, return on investment, beat a government bond. It is just quite rare, and it's something that I think would be a nice place to start an investment. And you're guaranteed the return.
Right. Right. Thank you so much for coming in studios. That has been the discussion. I'm sure you've learned a thing or two on how to invest. You don't have to start a business, go through the hassle, of starting a business. It's quite tasking. You can just look at the stock market, government bonds, get in there, invest and get your returns. My name is Malaki Vilodera. That's all we had for you today on Morning at 10 TV. Do have yourselves a blessed day.